Good morning, everyone. So, today we are going to start question number 14 onwards, our leverage buyout series. This is episode 30. My name is Deepak Bisht. Let's get started. So, question number 14 is asking the difference between a bank debt and a high yield debt. So, when discussing debt financing in leverage buyouts, two most common types of debt are bank debt and high yield debt. These two categories of debt are quite different, and understanding the distinction is key to evaluating the capital structure of the transaction. And I will walk you through the primary differences between them. So, the primary differences could be due to interest rates and yields, and covenants, maturity and amortization, secured and unsecured, or investors' base, and usage of leverage in LBOs. So, if we talk about interest rate and yields, there's a difference between interest rate and yields between a bank debt and a high yield debt. In a bank debt, typically the interest rate is low compared to a high yield debt. This is because bank debt is considered less risky due to the fact that it's secured by assets and usually holds seniority in capital structure. So the interest rate on the bank debt are usually floating and tied to a benchmark rate like LIBOR, London Interbank rate, or the Fed's fund rate, depending on the agreement. And in a high yield debt, if we talk from the interest rate perspective, interest rate and yield perspective, high yield debt often refers to as a junk bonds, which carries higher interest rates because it's considered riskier. And these bonds are typically unsecured and comes with a greater risk for investors. The interest rate on high yield debt are fixed, meaning they do not fluctuate with market rates. So in high yield, I mean, more the return, the riskier is the investment. So hence the name high yield. If we talk from the perspective of covenants means the terms and conditions which comes along with the debt. So a bank debt tends to have a maintenance covenant, which are designed to ensure that the company maintains a certain level of financial health. Common covenants might include maintaining a specific debt to EBITDA ratio or ensuring that liquidity stays above a certain threshold. And if the borrower breaches these covenants, the lender has the right to call the loan or require the borrower to take corrective actions for a bank debt. And from a high yield perspective, typically includes in occurrence covenants, which restrict certain actions the company can take out, but do not require the company to maintain ongoing financial metrics. For example, incurrence covenants might prevent the company from taking on additional debt, making asset sale or paying dividend without prior approval from the lenders. If the company breaches an in-occurrence covenant, the debt could be accelerated, but there is less ongoing monitoring compared to a maintenance covenant because there is no underlying in a high yield debt. So that's why there is I mean less ongoing monitoring as compared to a maintenance covenant because there is a collateral. And that's why the interest rates are low. And when we talk from a perspective of maturity and amortization, so bank debt is often structured with amortization, meaning that the borrower is required to make regular principal payments over the life of the loan. This actually reduces the outstanding principal over time and spreads out the debt burden. This also makes bank debt less risky for lenders because the principal is gradually paid down. And for a high yield bond or a high yield debt, this is generally this kind of a debt actually has a bullet maturity, meaning the principal is due in full at the maturity date, which is typically 5 to 10 years from issuance. There is no requirement for regular principal payments, so company will need to either refinance or repay the debt in full when it matures. So this structure can be riskier for borrowers, especially if the company's cash flow or market conditions change. For okay, so next point is that the secured or unsecured. So from the securities point of perspective, when we talk about a bank debt, so bank debt is typically secured by a company's assets such as property, equipment, or receivables, and this provides a lender with a claim on the company's assets in the event of default, making it less risky for the lender's perspective, from a lender's perspective, and hence the interest rate is low for a bank debt. And for a high yield debt, it's often unsecured, meaning there is no specific asset backing the loan. So the lenders are relying on the company's overall creditworthiness and ability to generate cash flow to repay the debt. And due to the lack of the collateral, high yield debt carries a higher risk and consequently higher interest rate. So that is the main differentiator in when we talk about secured or unsecured. That that explains everything about the high yield bond, high yield debt, and bank debt, and also investors base. If you think about from an investor's perspective, investor base means that okay, so bank debt is primarily held by traditional banks and financial institutions, and these lenders are generally looking for stable returns and prefer relatively safety for secured debt with floating rates. When we talk about a high yield debt, so high yield debt is typically purchased by institutional investors such as high yield bonds, bond funds, or hedge funds, and also private equity firms sometimes. So these investors are more willing to take on higher risk in exchange for a potential for higher return. And usage of this in leverage buyout, if we talk about the usage, so in a leverage buyout, private equity firms typically use both bank debt and high yield debt as a part of their capital structure. Bank debt is often used for senior portion of the financing due to its low cost and secured nature, while high yield debt may be used for subordinated or junior portion of the capital structure. Okay. High yield debt actually provides flexibility by allowing the company to take on more leverage and without requiring immediate principal payments, which is crucial in leverage buyout scenarios where the goal is to maximize the return on equity. So the specific proportions of bank debt versus high yield debt depend on the risk profile of the transaction. I mean, the market conditions at the time of the financing and the target company's financial profile. So if I actually have to conclude in conclusion, in summarized version, so bank debt tend to have lower interest rate, floating interest rates, maintenance covenants, and amortization schedules, which also makes it safer, more structured form of a debt. And on the other hand, high yield debt carries higher interest rate, fixed interest, incurrence covenants, and bullet maturities, making it more flexible but riskier for both the issuer and the investor. And in the context of leverage buyout, the combination of both type of debt allowed the private equity firm to optimize the capital structure and balances the cost of debt with financial flexibility. So I hope this is clear. We have discussed this thing in detail now, debt, bank debt, and high yield debt. And okay, let's move to question number 15 now. So question number 15 is about why might you use a bank debt rather than a high yield debt in a leverage buyout? So in a leverage buyout, a private equity firm might prefer to use a bank debt over high yield debt for several strategic reasons tied to the cost, flexibility and operating profile for the of the target business. Low Okay, first point would be that low interest cost and reduced cash burden. Second point would be that more sustainable when cash flows are volatile or uncertain. So that's why it's more sustainable to have a high yield, bank debt. Third is that fewer restrictions on operational growths because in a high yield debt, there there is in covenants which actually debars. I mean, he stops the debt holder to do certain things which are not in favor of the debt or which are restricted by the debt provider, to fewer restrictions on operational growth, and better for early stage turnaround on investment heavy strategies. And okay, let's discuss about if the point that where we are where we will discuss about the lower interest cost and reduced cash burden. So bank debt typically carries lower interest rate than high yield bonds because it is secured and senior in the capital structure. So this directly reduces the company's cash interest expense, which is typically important in a leverage buyout because cash flow is tight in the early years. And using lower cost bank debt helps ensure the company can meet its interest obligation and maintain enough liquidity for operations. And previously in the question number 14 also we discussed the same thing. And okay, if we talk about point number two, which means that it's more suitable when cash flows are volatile or uncertain. This means that if the target company has less predictable or seasonal cash flow, bank debt provides greater safety. Lower interest payments reduces the risk of default, and if it also gives the company more breathing room while the private equity firms execute operational improvements. And the point number three would be fewer restrictions on operational growths. And in this part, we are going to discuss about the covenants. So, high yield debt typically has incurrence covenants, which can restrict the actions such as raising additional debt, selling assets, or raising funds, funding acquisition, issuing dividends. And if the private equity firm plans to pursue any of those, like capital expenditure, they want to do some capital expenditure, or they are planning to expand, or any other merger and acquisition activity or operational restructuring, they may prefer bank debt since it usually imposes maintenance covenant rather than restrictions on the corporate actions. And despite bank debt being more restrictive on on performance metrics, it actually gives more flexible operationally. So bank debt is actually more flexible operationally, and it gives them a more operational flexibility. And if you think about whether it's, I mean, for companies that need meaningful upfront investment, for example, plant upgrades or new store openings or technology modernization, bank debt is often the better option because high yield holders may block those initiatives through incurrence covenants. So it's better for early stage turnaround on or investment heavy strategies. So bank debt is better. And the market conditions, and if we talk about the market condition and financing environment, in favorable market conditions, credit markets, banks may offer very attractive pricing and terms, making bank debt more economical than issuing high yield bonds. And conversely, if the high yield market is volatile, spreads can widen significantly, making it too expensive related to a bank debt. So, in summary, you would choose a bank debt when you want lower cost of capital, less cash interest burden, more flexibility on operational and strategic initiatives, a safer structure for businesses with the value on uncertain cash flows, and high yield debt offers fewer financial covenants but can restrict corporate actions. So bank debt is often the safer and more economical choice early in an choice I mean made in an leverage buyout. So this was actually a very good question, and we have discussed this in detail now. The why the bank debt would be preferred rather than a high yield debt in a leverage buyout. And okay, let's move to question number 16 now. The question number 16 is, why would a private equity firm prefer high yield debt instead? Okay, so why would a private equity firm prefer high yield debt? And In a leverage buyout, a private equity firm might choose to use high yield debt instead of bank debt for several reasons, and often related to capital structure optimization, flexibility, and strategic plans for the company. While high yield debt is more expensive, it offers unique advantage that can align better with the private equity firm's objectives, especially when their focus is on the higher leverage or future refinancing. So, if you think from the lower amortization requirements and the cash flow flexibility perspective, so high yield debt typically comes with a bullet maturity, meaning that the principal is due at the end of the loan, where like say, at the end of the loan term. Uh, and a bank debt usually require amortization over time. So this lower initial cash burden can be appealing for a private equity firm, especially when the target company is not generating immediate strong cash flow, or when the firm plans to use the early years of investment to improve the operations or growth. So this could be one reason. But by not having to make principal payments until the maturity, the company retains more cash for the operational needs, or for paying down their obligations. So this is the one point where high yield debt is preferred rather than a bank debt. And in previous question 15, we were discussing about why bank debt would be preferred over high yield debt. And here in this question, we are talking in favor of high yield debt. And from a perspective of potential for refinancing, so this could be one of the reason a private equity firm might opt for high yield debt. Is that if they plan to refinance the debt at some point, so either through the high yield market again or through a sale of the company. So high yield debt is typically structured in a way that it allows for greater flexibility in refinancing. And in a private equity, if a private equity firm expects that interest rates would drop or the company's credit worthiness will improve after a few years, they may be able to refinance at more favorable terms before the bullet maturity date arrives. And the private equity firm might also expect the company to become more stable and attractive to investors, which would make refinancing in a high yield or investment grade market easier. So it actually gives an investor a potential for refinancing, a better potential for refinancing. And also there are less restrictions on the covenants. Less restrictions mean there is an operational flexibility. So high yield debt typically has in-occurrence covenants, which are generally less restrictive compared to maintenance covenants and found in bank debt. So maintenance covenants are actually found in bank debts, and incurrence covenants are generally less restrictive compared to maintenance covenants. And maintenance covenant require the company to maintain certain financial metrics like debt to EBITDA ratio or interest coverage ratio. So these covenants can be challenging if the company's performance fluctuate. So in occurrence covenant in high yield debt, however, it only triggers if the company wants to take specific actions such as issuing new debt, paying dividend, or selling assets. So this gives the company a greater freedom to pursue growth strategies such as acquisition, capital structure, or restructuring without the consent concern without the consent from the without any I mean, having any consent concerned to the breaching of covenants. So and the flexibility can be especially useful if the private equity firm does not plan to sell the asset or engage in significant strategic moves that could trigger the covenants in the bank debt. And also, preferring giving a preference to high yield debt also gives higher leverage potential. So, high yield debt can be attractive option if the private equity firm want to max out leverage by increasing equity returns particularly if they don't mind the higher interest rates associated with it. And in an LBO, the ability to use leverage can significantly amplify returns, especially when combined with non-amortizing debt structures. By issuing a high yield bond, the private equity firm could can use more debt while keeping monthly obligations manageable in short terms. And also, while the cost of capital is high, with high yield debt, the private equity firm might be willing to accept the higher interest expenses, and particularly if they believe they can refinance, or if their equity returns are not overly sensitive to the interest payments. And the long-term focus on exit strategy also is in favor of high yield debt, because in a private equity firm, if the private equity firm plans to exit the investment through a sale of public offering for in a few years, so high yield debt can make the exit process smoother. High yield bonds are generally more marketable than liquid, so they may appeal to investors looking to buy the company. High yield bonds offering could make the company more attractive to potential buyers by providing a cleaner capital structure or a less cumbersome debt maturity profile. Additionally, by issuing high yield debt, the private equity firm could potentially push off the debt maturity and until close, I mean, push off the debt maturity until closer to their planned exit, which can align better with their exit timeline and increase the flexibility and flexibility in achieving their target returns. And also market conditions and investor appetite. Sometimes high yield debt may simply be a better option because of market conditions. And in periods where the high yield bond market is attractive or active and investors' appetite for risk is high, the private equity firm might find it easier or more cost effective to issue bonds rather than rely on the bank debt. And during bull market, institutional investors may be more willing to take on risk, allowing the private equity firm to access capital with relatively favorable terms, even if the interest rates are higher on the bank debt. So, in summary, the private equity firm might prefer high yield debt in a leverage buyout for several reasons, including less frequent principal payments because of the bullet structure, uh, bullet maturity, improving near term cash flow flexibility, the possibility of refinance the debt in the future under better terms, less restrictive covenants, allowing them more operational freedom to execute growth and restructuring strategies. Um, the ability to take on more leverage without burdening the company with large cash payments early in the investment, and a better fit for the company's or firm's better exit strategy, or when the market conditions favor high yield issuance. And by optimizing the high yield debt, the private equity firm sacrifices some security and flexibility in exchange for potentially high leverage and reduces short term financial pressure, and a strategy focuses on long term growth or a future exit. I hope this question was clear and we have discussed this in detail now. Uh, let's move to next question, question number 17. So, okay, let me just discuss about this one more time. So, question number 15, we discussed about why would we prefer bank debt. And in question number 16, we have discussed why would we prefer high yield debt. So, in both, in a company's structure, a company's capital structure, both of these debts are there. So, it's not like one debt is good and one another is bad. No, it's about times and what are the features of those debts. We will discuss about this in detail when we'll do the advanced questions. For advanced questions, you need to understand the basic concepts first. So let's move to question number 17 now. So why would a private equity firm buy a company in a risky industry such as technology? So technology firms are considered as risky businesses. So why would a private equity firm want to buy a risky company? And with risk comes reward. So more the risk, the more the rewards. So let's discuss about this. So while it's okay, it's true that the technology is often more volatile and risky industry compared to the traditional sectors. Private equity firms are typically opportunistic investors. So, opportunistic investors is not about optimism, but it's about opportunity. So they are finding an opportunity to invest, and they view risk differently than other types of investors. And even in high risk sector, they are compelling reasons why a private equity fund might choose to acquire a company. So the first point would be market growth potential. So technology is inherently innovative and high growth, even though it can be volatile. So many private equity firms are attracted to tech companies because of the potential of exponential growth. For example, if a company is in an emerging or rapidly evolving market, it could see substantial upside over a relatively short period. And disruptive technologies means such as artificial intelligence, blockchain, and cloud computing, etc., may offer massive returns if the firm can identify and capitalize on trends before they become mainstream. So, a private equity firm that focuses on growth opportunities in the technology space may be willing to accept the higher risk for the potential for outsized returns. They they see volatility as an opportunity to capture value before the market catches up. Second point would be that there's a turnout potential. Turnaround potential means that even in a risky industry like technology, there may be cases where technology companies are not living up to their potential. So a private equity firm may invest in a technology company that is struggling for a reason, uh, such as mismanagement, inefficient operations, underinvesting in R&D or marketing. And if a private equity firm believes it can bring operational expertise or leadership to turn around a struggling company may, I mean, turn around a struggling company, they may be willing to take on the risk. Many private equity firms specialize in turnarounds where they work to optimize operations, improve margins, restructure debt, and focus on profitability. So, for example, a technology company might have great products or intellectual property, but it's poorly managed. So, a private equity firm might acquire it, bring in a new management team, and focus on execution, and ultimately leading to a profitable exit. And from an industry consolidation point of view, industries like software, telecom, and hardware often consist of fragmented markets with many small or mid-sized players. So a private equity firm may see an opportunity to consolidate these fragment businesses into stronger and more efficient entity. Merger and acquisition can create synergies by consolidating operations, increasing market share, and reducing cost. Uh, this can make the combined entity more competitive and more profitable. And by acquiring competitors and creating economies of scale, the private equity firm can drive value and increase the overall market power of the combined companies. So consolidated consolidation also offers the possibility of enhancing customer reach and improving technology platform, which could be particularly attractive in markets like enterprise software or fintech. And also from strategic divestiture or spin-off perspective, if you look at it, the private equity firms also specialize in divestitures and carve-outs, so spin-offs, which involve acquiring divisions or units of a company that may not be core to the parent's strategy, but hold value in their own. So if a tech company has a non-core division, that is underperforming or neglected by the parent company. So a private equity firm might acquire it with plans to spin it off as a standalone business. And similarly, a private equity firm might acquire a technology company to divest certain assets such as proprietary technology or intellectual property and sell its asset to a more suitable buyer, realizing value from what is often a non-strategic or underutilized resource. And in some cases, the private equity firm may believe that the technology is underappreciated in its current corporate structure and can be spun off to unlock value and making it an attractive investment despite the inherent risk of the industry. And expertise in technology or a niche market also drive private equity firms to acquire a technology company, because some private equity firms specialize in specific industries, including technology, and may have the knowledge and expertise to navigate the complexities of the sector. These firms understand the risk but are well equipped to manage them. So, for example, technology focused private equity firm may have deep industry relations, technical expertise, and a clear understanding of the market dynamics that allow them to make more informed decision and mitigate risk. They may also have a strong network of strategic buyers, venture capitalists, or industry experts that can help them assess the potential upside and the risk more accurately. And in this context, a private equity firm may have the necessary resources and insights to identify opportunities in the technology sector that others might overlook. And the technology sector has high exit multiples compared to other industries, driven by the attractive growth potential and the appetite for tech companies for from both public markets and strategic buyers. If the private equity firm can buy low and exit high, the premium exit valuation in the tech sector can justify the higher level of the risk. And tech IPOs and strategic acquisitions are common exit routes, offering significant upside potential for a private equity firm that can hold the company for the right period. For example, if a private equity firm might acquire an early stage startup or early stage technology company at a relatively low valuation, then grow it over a few years, leading to a lucrative exit via an IPO or acquisition by a larger player. And it also gives them diversification and portfolio balance. So private equity firms often build a diversified portfolio across industries and sectors to balance risk. Even if one investment is in high risk sector like technology, other investments in more stable sectors like consumer staples and healthcare can offer potential volatility. Can offset actually. This can offset the potential volatility. And in a private equity firm, uh, if they have already made successful investment in those sectors, in other sectors, adding a technology company could be a strategic way to diversify the and balance the overall portfolio risk profile. So, in summary, the private equity firm might choose to invest in a risky business or a risky industry such as technology and other because of the growth potential, because of turnout opportunities, because of industry consolidation, because of strategic diversions, or because of expertise and specializations also. Some private equity firms specialize in technology sector and have the knowledge and the network to navigate the risk. And high exit valuation, which could be a reason because tech companies often achieve high exit multiples, whether through IPOs or strategic sales, providing lucrative exit opportunities. And also, the last point would be I would want to discuss would be portfolio diversification. So, if portfolio diversification means that a tech company can balance out the PE firm's broader portfolio, especially if the firm already has a stable investment in those sectors. So portfolio diversification point I discussed late last, because if you are an individual investor, so you have stocks of so, different companies, different sectors. But a private equity firm's portfolio is way too different. They actually have companies on those portfolios. So which companies are making them profit and which companies are making them loss. They actually do not acquire shares or stocks, that they can do, but majorly they acquire companies, and then they revamp everything about the company. They fix the operations, make the company profitable, and then they sell it out. So if you or if any private equity firm has a specialization in technology, so they will prefer to take a technology firm, acquire a technology firm, and then do everything, then fix everything about the company and book profit after selling it out in the market. Uh, if the company is into real estate, so they will do, if they have expertise in other and any another sector, they will prefer those sectors. Or a private equity firm has different sector experts also, so they look into those companies, those kind of companies. All right, so I hope this is clear. We have discussed it in detail. So let's wrap up today's session here only. We will start from question number 18 onwards in our next session. So as of now, we have discussed about the why, I mean, the difference between bank debt and high debt and what we will prefer. In one case, we discussed about high yield debt, and one case we discussed about bank debt. The preference given to which one. And in here, this question, why would a private equity firm would be interested in buying a risky company, such as a risky industry, or in a, um, such as technology? So why would be they interested in getting into those kind of businesses which are risky in nature? So because of various factors like growth potential, turnaround opportunities, industry consolidation, strategy divestitures, expertise and specialization also, and portfolio diversification. So let's conclude this today's session. I will see you in the next session. Thank you and happy learning.